JBlog, June 13th, 2010. Some very interesting action on Friday and Thursday. Market had put in a bottom on, I believe on Tuesday there was a turnaround that happened. Then Wednesday there was some weakness. Thursday was a strong day. If you look at this graph, anyways, and Friday was again a strong day. Now, internally, it wasn't really that strong on several avenues. One of them is that volume was lower on Thursday and on Friday. So once again, rallies happen, but they are on reduced volume. Also, we're coming off of a very oversold, short-term oversold position, so it sort of makes sense for bears to take some shorts off the table here, cover some shorts, and produce a bit of a short rally in a short covering rally in the meantime. Does this mean we are starting back up like CNBC would make you believe? Again, I continue to not buy that. We'll see how that goes. This is a weak part of the year. It could very well be that we're going to go sideways now for June, July, and August. A little bit up, a little bit down. And then September and October could continue being ugly. We'll see where that goes. News stories are interesting right now, or actually statistics. One of the big pieces that came out is consumer confidence. Sales, of course, was completely discounted. The fact that sales fell was completely discounted because consumer confidence is up. Well, consumer confidence really isn't up. When you're looking at a longer term chart here, we're still far below what was historically a normal consumer confidence. Yes, we're increasing, but we're nowhere close to where we had been earlier. Here's a longer term chart. There's a shorter term chart that I've pulled off, and we're just basically getting back to where we were a long time ago. One thing that I find interesting is that consumer confidence has steadily dropped since the late 90s, has never regained the height of the late 90s in the 2000s, even at the height of the bubble, and of course now is much lower. Non farm payrolls, a lot of people make a lot out of this. That we're getting an increase here. A lot of that is government hiring. This is basically America indebting itself and future generations to pay for a temporary blip, and I very much doubt that it has staying power in the long term. Jobless claims continue going down. Now, there's a very interesting piece that came out last week by the Bank of Montreal. That's a Canadian bank. It's the second or third largest bank in Canada, I forget. Anyways, very, very conservative. And basically, the analyst here, who doesn't speak for the entire bank, but who, I mean, it does have the Bank of Montreal letterhead on it, so it's pretty significant. And they basically say, go to cash. Get out of the markets. Markets are not safe. This is more of a long-term rather than a short-term view, and it talks about China, and it talks about the Far East, and it talks about an Asia dollar index, and how this Asia dollar index is basically there's a possibility that Asian countries could fail as are European countries failing right now. It's a very interesting article. Now, you can believe it or you cannot believe it, but again, for the Bank of Montreal to publish something like this is quite significant, so I do pay quite a lot of attention to it. Here's a cute little chart that I came across. This is gross financial liabilities as a percentage of GDP for 2011. We've got the US at 100%, Canada at 90%, Japan at 200%. Germany at 90%, France at 100%, Italy at 130%. It just goes on and on. So a lot of countries that are in big trouble here. China is low. Um, I would personally challenge that view. China has the advantage of being able to make GDP whatever it wants to because they calculate the GDP quite differently from how the rest of the world calculates it, which is wrong still, but this is even more wrong because it can be manipulated any which way they want to. So this is probably a lot higher. I imagine this is quite high here. India, again, quite a bit of debt here. So there's just these are just bad numbers across. It's not a question of, oh, the US is okay and Europe is in trouble or the other way around. No, everyone is in trouble. All the governments are in trouble big time. And that's why this whole thing will not hold. It's that simple. Long term, it looks pretty grim. A few news stories that I came across. One very humorous one. Rubini here urges the European Bank to slash rates to counter the effects of austerity steps. Now, my sarcastic comment on that was somebody doesn't understand the concept of austerity. Now, austerity is supposed to be the cutback. So for him to suggest that they should be making money more available so that people can spend, uh, yeah, Rubini, crawl back underneath the rock where you come from. What can I say? But, you know, whatever. Um, the Congress wants the Rubini to be revalued. They want it higher. They want to for the U.S. to be more competitive with China. They're saying that China is undervaluing its currency. Of course they are. We know that. But Congress is now basically giving them another month or else. That's where protectionism comes in, and after protectionism comes war. That is very frequently been the way things work. Ludwig von Mises said so nicely that if goods don't cross borders, armies will, and that has happened historically quite a lot. So we are living in very, very uncertain times. So this is the retail sales that unexpectedly, I love that word, unexpectedly and surprisingly, it's full. The news is full of all of these maybe and might and will, and yeah, the news is now making news. It no longer just reports it; it wants to make it. So, unexpectedly. Whatever. One thing that is very significant about this is I don't know how this number is actually calculated, but if this is actually same store sales, then that could be even more significant a downturn. Because obviously with a lot of retail businesses having gone out of business, the remaining business should technically have increasing um, sales for same store. And if those sales actually went down, then that's even worse. Um, Anyways, what do we have here? Hong Kong is back above 20,000. Here's Friday, what Friday looked like, and this rally. It was flat for most of the day, and the rally basically happened in the last hour. This is the commercials. This is industrials driving things up. As I said before, industrials are heavy on all of this paper. They know it's overvalued, and they want the retail investor to go in there, think there's a rally, take it off their hands, so that they can go to cash and possibly even short this thing and get out with their fortunes intact that they've made. It doesn't look like the retail investor is buying into it, so we'll see how that all goes. I certainly hope that the little guy does not get screwed. Here's the picture. This is the most important picture. Again, this is the TED spread. TED spread is ugly. Banks are not trusting each other. Banks don't know what's on each other's balance sheet, and this will lead to another liquidity crisis. So if there's any chart in this presentation, then this is the one that basically says bad, bad, bad. That's all I have for today. Hope you have a good week. All the best and good luck.